Hi guys, welcome back. So, I have received some questions from the Discord members and YouTube comments asking me what I think about the news during the weekend that China fines Alibaba 2.8 billion after antitrust investigation. And since I have been recommending Alibaba and I've wanted to talk about my Alibaba analysis for a while, so in this video, I'm gonna first talk about whether I think this is good news or bad news. And two, I would discuss whether I think this is still a good investment. And three, I want to analyze what is Alibaba to China. And four, I'll give my suggestion on what to do regarding to the Alibaba stock. And finally, I want to also share how I think it would affect the other Chinese stocks. So now, let's begin. Number one, I think, is it a good news or a bad news? So let's just briefly go over what happened. So China slams Alibaba with a $2.8 billion fine for violating the anti-monopoly laws. So the CEO of Alibaba, Jack Ma, had criticized Chinese authorities for lack of financial system and restricting innovation in the country. And then later on, the IPO of the Ant Group had been put on pause at the last minute. And then Alibaba Group had got into the investigation of the anti-monopoly. And this has been going on for months. And finally, there is the conclusion to be the fine of 2.8 billion, which is equivalent to 4% of the company's domestic annual sales, while it could be 10% capped. And they can no longer perform the practice called 二选一, which literally means choose one out of two. So is this a black swan news? In my opinion, I don't think it is, because it is only a black swan when it's unexpected. But this has been going on for a while, and investors have been expecting a punishment from the government that might not be light. And if we look at the chart of Alibaba, so this was the pause of the IPO from the Ant Group. So that was the black swan news indeed at first. And then later on, when it was trying to recover from it, another black swan news coming down from the investigation of the anti-monopoly. So yes, it was a black swan news before, and it already caused the share price to respond to this. So at this point, while the market had been digesting the bad news already, I wouldn't call this again another black swan news, because it's already expected. I guess what's not expected would be the amount of the fine to be 2.8 billion, which is not a small amount at all. So right now at this point, I guess investors are worried how the market would respond to the amount of the fine to see whether it would drive the share price further down. For this, we can take a look at the regulation, because usually it could be within the range of 1 to 10% of the company's annual sales. And before this news, there was rumors saying that it could be somewhere around $1 billion of fine from the government. And 1 billion would be equivalent to be 1% of the annual sales. So it might indeed look to be too light punishment from the outside. So for them to make it 4%, I personally think it's not too light from the outside, and it's not too heavy that it would affect the company's fundamental. Because from the outside, even though the fine did hit a record of $2.8 billion to be the biggest in terms of the punishment within China. But if we look at a few years ago, back in 2015, China also fined Qualcomm, which is the leader of the 5G company, the amount of $975 million, near $1 billion, for the antitrust dispute. And it was also a record high at that time. So if you compare the size of Alibaba Group and the annual sales number with Qualcomm, then we certainly don't find 2.8 billion to be insane amount of fines. If it's really 1 billion, then it might actually look unfair to Qualcomm a few years ago, and also would add more suspicion of the Chinese government involving in the Alibaba Group. So I do think the fine for Alibaba needs to be more than Qualcomm's and not just by a little bit. So I do think this act from the government is under consideration of being more fair and strict to the management, and at the same time drawing a distinction between government and the Alibaba Group to kind of let the world know that the government is not involved in the Alibaba Group. And then let's see how much is $2.8 billion to Alibaba. Is it going to affect the company's fundamental? So as of the year of 2020, Alibaba holds cash amounts of 374 billion Hong Kong dollar, which is equivalent to around 48 billion US dollars. So this fine is about 5% of their cash balance. And we need to also remember that they just recently announced and upsized their share repurchase program to US $10 billion, effective for a period through the end of 2022. So it means within this 1 to 2 years, they have at least $10 billion that they can spare. And the second reason is because they also think the current price of Alibaba Group is unfairly low. So knowing this, at least it can put the mind of Alibaba's investor more at ease, that the fine is not going to destroy them. And it is about a quarter of the amount of money that they plan to spare to repurchase their stock. And on the other hand, the good news is that we should know this is near the end of the bad news, because investors just hate uncertainties. And for this to settle down, at least we have some certainties already. And also, during these few months, there were so many speculations and rumors about how the government might take control of the Alibaba Group, or at least split the businesses into different sectors. For example, the e-commerce, the health, the cloud, the fintech, etc. And also, there were rumors about Jack Ma being missing after criticizing the party. That is another scary thought. So many voices started to speculate on how the Chinese government would take over any business that had grown bigger and the CEO can disappear anytime. That is definitely quite some scary thought. Also, the reason why the share price can be constantly staying down on the floor for the recent few months after being attacked and attacked. So that's why I think at least now the good news is that all those scary voices have been swept out of the air, and seems like what people scare the most, like for the government to take control and to split their businesses, is not going to happen. Number 2, is this still a good investment? For this, we need to know that Alibaba is still considered by many large investors to be a money printing machine. First of all, we need to know that Alibaba is really not just an e-commerce platform. It has been building a whole ecosystem for quite a few years already. From e-commerce expanding to cloud business, which is now probably the business with the highest margin, and a lot of other companies want to step their foot into. But the Ali Cloud business has one of the best competitive advantage. Also recently, because of the COVID in the last year, it had suddenly boosted their sector of online working. Dingding is the platform. It's similar to Zoom for the US, at the same time helping the growth of Ali Cloud. And their Alipay business is still the world's top leader of mobile payment by far, and currently aggressively expanding to overseas from Asia to Europe and North America, even though it's affected by the COVID currently. Right now, I know they're putting more efforts on artificial intelligence, which is why they're developing the Tmall Genie, something that Baidu is doing, similar to Alexa. And let's not overlook the Ali Health, because I think this is one of the most important strategic moves from Alibaba to get into the health sector. Health and education are the two sectors in China that the demand seems to be always there and growing, even though the supply is growing so fast. let's just take a look at Ali Health Financial for a second. In 2020, their revenue had grown 74% year over year, and the profit for the 6 months ended September 30, 2020 was $278 million, compared to the loss of $7 million in the previous year. So we see that they're starting to turn positive on profit, and that is a very good sign and very strong signal for the company. With that said, Alibaba is currently trading at the PE ratio of 25 with the market cap of $608 billion. And if we compare to Amazon, currently trading at the PE ratio of 80 with the market cap of $1.6 trillion. So hypothetically, if Alibaba can be traded as the same PE ratio as Amazon, the share price should be trading at $712 right now, more than triple than the current price. And I think based on the reasons and research I just analyzed, that is why we see Charlie Munger, the partner of Warren Buffett, taking a huge position on Alibaba recently. So we know Warren Buffett and Charlie Munger are both value investors. When they buy a company, they aim to hold it for at least years to begin with. And he just added this in his portfolio to be the number 3 position after Bank of America and Wells Fargo during the first quarter of 2021. And we know by then they already had known the drama from the anti-monopoly and all the news about the political issue. So they are well aware of that and make this big decision with all the consideration and assessment. And I think we can expect them to hold this for quite some time because based on their past investment style, they usually hold a company and can usually ignore the daily news and rumors. Now, some people might be worried about the pick one from the two tactic. What is this pick one from the two? So this is a tactic that the tech giant have been using, like Alibaba and Tencent, to basically let small vendors choose between the two. For example, Alibaba can make a business vendor to choose from selling their products on JD.com or Tmall.com. And in this case, most of them might choose Tmall.com because of course it has a bigger consumer base and they would be entering a bigger platform. And the giants have been using these tactics for years already. Tencent have been punished for that. So now the government is trying to regulate this and basically banning Alibaba from doing this in the future. So some people might worry that without this tactic, it would significantly lower the advantage of Alibaba and let all the newcomers like Pinduoduo and some other new and smaller platforms to take over the market share of e-commerce. I think in the short term, it might benefit JD.com and Pinduoduo for some time, but I personally don't think this is a big hit for Alibaba that would change their competitiveness. Because I think the strongest moat for Alibaba is not just their size of the company, but the strong ecosystem they have just built already in the past for the last decade. And this is very hard to be replaced. At least it would take years. Remember the video I did about NIO, describing NIO's business model? I said that NIO's strongest moat is the ecosystem that it has been building along the years. And the most difficult part is the consumer habit, because it requires the most money and time to build. Usually like a mission impossible. And this is the same thing for what Alibaba had done. Just like NIO had been training the users to use battery swap and BaaS, Alibaba had been basically educating the Chinese consumers all these years how to shop. I think they have been defining e-commerce, setting the rules and standards, shaping out the logistics, building infrastructure. And this is not something that's easy to copy or replace Because the hardest thing and the longest to make is the consumer habits, what people are used to. For most of the tech company, consumers already gave them a definition based on their habit. For example, Tencent is for gaming and social. So when they try to do e-commerce for a long time, it just doesn't work so well because people are used to going on WeChat to chat, to contact their friends, and not so much to shop. And it goes both ways. It's the same for Alibaba. When they try to do Lucky Pocket on Alipay, it doesn't work because people use Alipay for payment, not to connect with their friends. For now, Alibaba still holds the dominant position in e-commerce, and it's very hard to steal market share from them. Pinduoduo was quite smart to begin with the third and fourth tier city because it was what Alibaba was losing to begin with. As more and more concerns and debates over the Taobao platform having too many counterfeit items. So in order to regulate, to protect brands, Taobao had to give up some part of this. And this is when Pinduoduo took the opportunity to rise. JD.com stick with their core business of electronics and took the chance to build the massive infrastructure of logistics and improve their advantage, so then they could have their section to survive. Based on this advantage, Meituan is for food deliveries, and this it's also what Alibaba tried to get from, at some point sharing almost half of the market share, but still now couldn't beat Meituan because it's just the user habit that's hard to beat. And Amazon China had big plan for expansion in China, but still now only squeezed to the elite section of e-commerce in China, taking a very small and niche market share in the Chinese market for e-commerce, mostly on overseas shopping. So consumers have the habit fixed from years, and it's quite hard to change, and that is the strongest mode of Alibaba in terms of their e-commerce business. This is why I don't think banning them from the choose one from the two tactics can truly harm their business at all. At most, I think it just opens up more competition and push forward for more innovation in the field. So this might be a healthy regulation for the market environment, for better innovation. And number 3, I want to briefly talk about what is Alibaba to China. And first of all, I think the Chinese government still wants Alibaba very much to incubate the Chinese brands. Remember back in January, I did the video to talk about Chinese stocks, and I talked about the government's big plan and strategy to grow Chinese brands. The rising labor cost, it's undefeatable. And when more and more international brands are moving their supply chain out of China, there will be massive excess of manufacturing capacity. And for this, the government needs to grow a lot of domestic brands to solve this issue. And I also mentioned within this process, what is playing a very key essential role is Alibaba. Because for all these years, it had already incubated a lot of domestic brands. Like take one of our stocks, YSG for example. For a new startup company to take over a considerable portion of the market share from international brands such as L'Oreal and Estee Lauder within 2 years. This cannot happen without the mature infrastructure of e-commerce that's been built for the last decades. And we have to give credits to Alibaba. Not only they have built the infrastructure and shaped out the consumer habits, they also shape the supply chain of the whole e-commerce ecosystem. And I don't mean just by the logistic infrastructure, but really the whole supply chain related to e-commerce from top to bottom. To give you a few examples, the strategic and marketing agencies, the data analytic service provider, the photography team and the graphic design agencies, the KOL, the bloggers. All of these service providers are part of the supply chain of the e-commerce ecosystem, and they have gone to be quite mature and competitive over the years. And that is why a new brand startup like YSG can grow so fast within 2 years. And over the years, Alibaba had helped incubate many domestic brands that no one would have known, as they had been only the manufacturers of international brands for the last few decades. So that's why 3 months ago I said that I did not think the Chinese government would for real punish Alibaba heavily, because at the end of the day, I thought it was like the left hand hitting the right hand. It would never hurt. Second thing is that for the future, Alibaba is defining new retail. This is really for the future, upcoming 5 to 10 years. I also talked about it within the video about LKCO. I think in the future, we should expect to see new retail to shape out how things come to us. And this is something we should expect the tech giant like Alibaba to form and to define. And also, we can revisit the 1, 2, 3 smart logistic again. When the Chinese government has been planning to build this smart logistic system that allows 1 day delivery to the whole country, 2 days delivery to nearby countries, and 3 days delivery to the whole world, what this benefits the most, I think, is still Alibaba. Once the long waiting time of the delivery problem is solved, we should expect e-commerce or retail to change a lot internationally. And I do think the government has planned Alibaba in this picture. Number 4, what to do now with the Alibaba stock? So first of all, a lot of people worry that it would be a bad news and drive the share price to drop further, and they should sell it on Monday. Well, let's see. If we pull out the chart, we can see that this big fall recently has brought Alibaba's share price back to the beginning of 2020 and not far away from the peak in 2018 before the trade war between China and US. So I find it very hard to believe, considering the growth the company had done over the past 2 to 3 years already, to remain a similar value and to drop much further. And I think a lot of the bad news had been digested already with the falls recently. At the end of 2020 in December, because of the start of the investigation, it caused the share price to drop to the lowest of 211, which had been a long time support for quite a while already. And at most, really, the worst case scenario, I would think it's the support of 119. But this would be less of the possibility, I think. I still think the share price has been forming a nice bottom already. And I still think it's a good company for long-term investment and for value investors. For me personally, if you still remember, I have bought Baba first during the delisting news in May last year, around 198, but I did not sell it during the run-up. After the fall, I have bought the dip on this day at 220 and 212. And I have sold out of my position a few months ago and recently have started to buy the leap call options. And I think now it's a good time to build the position and hold it for the long term. And at last, number 5, how does it affect other Chinese stocks? First of all, I see some good news here because it did erase a lot of the conspiracy about how the Chinese government cannot take it when a company grows big and the CEO would disappear, the government would take control of the company, etc. This news at least had drew a clear distinction from the government to the company. So at least we are actually reducing the political risk involved in Chinese companies here. I also see this as the Chinese government telling the world that they are being fair in terms of their management and the punishment. So I see it as a statement showing the world, which means to me that they're doing this to a lot of investors in the world, and they do care about the Chinese stocks listed in the US stock exchange. Because I've been hearing a lot of comments saying that the Chinese government doesn't care about stocks being listed in the foreign market. And they think they want the companies to all come back to be listed in the Hong Kong market to help the Hong Kong Stock Exchange. And I think it's yes and no, because at the end of the day, of course, they want the Chinese stocks listed in foreign stock exchange to do well. and to have the least political issue as possible. So I hope this is just the first step of everything, and we will keep seeing things get better from here. For me, I won't worry too much about the dropping of the share price, but maybe take it more as an opportunity instead. Another note to mention before I finish is Pinduoduo, ticker symbol PDD, because unlike the other Chinese stocks, this is actually the rare few stocks that benefit from the whole anti-monopoly news of Alibaba. You see these few days? Those were the period during the black swan of Alibaba and caused a lot of Chinese stocks to crash. And on the other hand, we see a big run up for Pinduoduo afterwards. I think the market has been pricing in the good news because Alibaba cannot use the choose one between the two tactics anymore. And it had grew from the low 100 to the top of 212. So that's why during this run up, people ask me what I think about Pinduoduo. I said I wouldn't recommend to chase because it was running up pricing in the good news. And right now it's gone back down. It's probably enough correction, but it might still take time to rest or cool off after a strong price in of that. It's just something I want to share, but of course you need to do more research about it if you want to invest in Pinduoduo or already holding it. Now that's it for my video today as a weekend edition. And if you have enjoyed this video, I hope everybody is enjoying your great weekend so far. And if you have enjoyed this video, please give me a big like and write me a great comment. And I will see you in my next video. That's it guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.